All right, today we're tackling a real head scratcher from the world of ETFs. It's a fascinating puzzle about two funds that look almost identical but are secretly built for completely different missions.
It's a classic Wall Street mystery, right? You've got one company, State Street. They offer two ETFs, SPY and SPYM, that both track the exact same thing, the S&P 500. So why on earth would they create two products that basically compete with each other? Well, as we're about to find out, it's not redundant at all. It's actually kind of brilliant.
So in one corner, you've got the original, the heavyweight champion, SPY. This thing launched way back in 1993. I mean, it's practically ancient in ETF years, an absolute legend. And in the other corner, you have the challenger, SPYM. It's the newer, leaner, and, as we'll see, cheaper kid on the block. Okay, so if we're going to crack this case, the first place we have to look is the most obvious one. We need to follow the money. Let's talk about cost. Every single ETF has what's called an expense ratio. Just think of it like a tiny annual subscription fee you pay for owning a piece of the fund. It covers all the behind-the-scenes operating costs. And even though it's a super small percentage, oh boy, does it make a huge difference over time.
And when you put these two side by side on cost, it's not even a fair fight. SPY clocks in at 0.0945%, while SPYM is just 0.02%. That makes SPYM nearly 5 times cheaper to hold every year. So round one, on annual fees alone, definitely goes to SPYM. So what does that actually mean for your wallet? Well, on a $10,000 investment, choosing SPYM saves you about $7.45 every year. And I know what you might be thinking, $7, who cares? But in finance, that's a difference of about 7.5 basis points. And trust me, those little points are a huge deal.
And that's because for anyone investing for the long haul, those basis points are everything. It's not just $7 a year, it's $7 that isn't working for you, that isn't compounding and growing, year after year, decade after decade. A lower fee is like giving your investment a constant tailwind. But hold on, if SPY is so much cheaper, why does anyone still buy SPY? I mean, SPY is still an absolute Goliath in this space. That tells us there's another piece to this puzzle, a hidden clue that explains everything. And that clue is something called liquidity. And the scale of this is just mind-boggling. Look at this. SPY is managing over $500 billion in assets, and it trades more than $52 billion every single day. SPYM, it's just a drop in the ocean by comparison. This isn't just about size. It's about what you can do with that size. Yeah, check this out. Back in February 2020, right when the pandemic panic was hitting the markets, SPY traded over $100 billion in a single day. Think about that. When the market is in free fall and everyone is rushing for the exits, they're not running to the cheapest option, they're running to the biggest, most reliable one, the one with that giant, deep pool of liquidity.
So here's the crucial takeaway. All of that trading activity, that massive liquidity, it translates directly into lower trading costs. Because there are millions of buyers and sellers for SPY at any given second, the tiny gap between the buy price and the sell price, the bid-ask spread, is microscopically small. So yeah, SPY costs more to hold, but it costs way, way less to actually trade.
And just like that, the mystery starts to unravel. You see, SPY and SPYM aren't actually competitors. They're not two tools for the same job. They are two very different tools built for two very different jobs and for two totally different types of people. Exactly. Think of it this way. SPY is built for the active trader, the person who's in and out of the market, making quick moves, rebalancing constantly. They need that low-cost trading, that instant liquidity. Then you have SPYM. That's built for the long-term investor, the person who's buying and holding for years, maybe decades. For them, minimizing those annual fees is the name of the game. It all comes down to what's called the total cost of ownership. You have to look at both pieces of the puzzle, the holding cost, which is that annual expense ratio, and the trading cost from that bid-ask spread. Which one is better totally depends on which of those costs matters more to your specific strategy. So let's play this out. Imagine you're a super active trader. You're constantly rebalancing your portfolio or making tactical moves. Your biggest enemy isn't that tiny annual fee. It's the cost you pay on every single one of those trades. And look what happens. In that scenario, where you're trading a lot, SPY actually comes out cheaper overall.
The money you save on those razor-thin trading spreads more than makes up for its higher annual fee. For active traders, liquidity is king, and SPY wears the crown.
Okay, now let's flip the script. You're not a trader. You're a long-term buy and hold investor. You're putting money away for retirement, maybe 10, 20, 30 years down the road. Your strategy is simple. You buy, and then you do pretty much nothing.
And over that kind of timeline, the tables completely turn. Suddenly, those one-time trading costs barely matter because you're just not trading that often. Now, that annual expense ratio becomes the dominant factor, slowly eating away at your returns. And this is where SPYM, with its super low fee, becomes the clear winner. The power of those compounding savings is just incredible.
So that brings us back to the original question. Why doesn't State Street just lower SPY's fee and call it a day? Well, the answer is pretty simple. Business. SPY is an absolute cash cow, bringing in over $665 million a year in fees. If they cut that fee to match SPYM, they'd lose over $500 million in revenue. It was way smarter for them to launch a new, low-cost fund to capture that buy-and-hold market without messing with their golden goose.
Okay, so we've cracked the case. We know why both of these exist. Now for the most important part. How do you figure out which one is right for you?
When you look at these two funds, the right choice depends entirely on your personal game plan. It's all about what kind of player you are. And it really just boils down to two simple questions. First, how often are you planning to trade? Are we talking monthly, quarterly, or maybe just once a year? And second, what's your timeline? Are you in this for short-term tactical play, or are you in it for the long, long haul? Your answers to those questions will tell you everything you need to know. Because at the end of the day, it's not about which ETF is better, but which one is the right tool for your job. So the real question to ask yourself is this: are you trying to trade the market, or are you trying to own it?